Authoritative. Focus. Thursday's price action, the trap, and the psychological setup. Look, I'm coming in hot today because what we just witnessed on Thursday and Friday wasn't some routine market fluctuation. It wasn't just another good week for precious metals. If you were busy or distracted for even a few hours, you missed the opening snap of what I believe is going to be the most violent, most aggressive repricing the silver mining sector has seen in a generation. It's Saturday evening, January 18th, 2026, and the fuse hasn't just been lit. The explosion has already started. Let's be clear about the mechanics here. The metal itself? Silver didn't do anything world-shattering. It held its ground. It stayed steady. But the miners? The miners basically threw a chair through the window and walked out. Now, if you think I'm being overly dramatic, good. You should be paying attention, because once a move of this magnitude starts, you don't get a polite invitation or a second chance to enter at a fair price. You either grasp the structural mechanics early, or you're left chasing headlines after the smart money has already cashed out and moved on. Before we dive into the meat of this gamma squeeze, do me a quick favor. My stats show that a massive chunk of you guys watch these breakdowns every single week, but haven't hit that subscribe button yet. If you value this deep dive research, hit subscribe and drop OG John AG in the comments. I want to know who the real crew is. Now let's talk about the trap. Picture Thursday, January 16th. It was monthly options expiration, or OPEX. For the uninitiated, OPEX is the day where billions of dollars in derivative bets either quietly expire or blow up in someone AS face. It's the day the market stops pretending and everyone has to show their cards. Thursday morning opened like a textbook trap. We saw a fast hit, a sharp, calculated drop. Silver got slammed down a couple of bucks in the blink of an eye. This is a classic stop-run maneuver designed to trigger sell orders, shake out the weak hands, and keep those critical call options out of the money. For a few hours it looked like the shorts had won. The screen was red, the mood was somber, and the noise machines were ready to tell you that silver was dead. But then, something shifted. Around late morning, massive buying started hitting the tape. This wasn't retail mom-and-pop buying. These were big prints, institutional blocks, the kind of orders that don't ask for permission. By the time the closing bell rang, silver hadn't just recovered. It closed above the key strike zone. And that one fact? That flipped the entire script from safe to total chaos for the dealers. Analytical, intense, and revelatory. Focus. Friday's 8.3% surge, dealer hedging, and the force buying loop. If Thursday was the setup, Friday, January 17th, was the confirmation punch to the gut for anyone short this sector. Let's look at the scoreboard because the numbers don't lie. The Silver Miners ETF, SIL, ripped a staggering 8.3% in a single session. Meanwhile, the underlying metal, silver, was only up about 2.1%. I want you to pause and let that sink in. The miners moved roughly 4 times faster than the metal itself. That is not investor optimism. That is not a nice little rally. That is forced, mechanical behavior. This is what happens when desks are scrambling to cover their tracks so they don't get carried out on a stretcher. If this is your first time hearing the phrase gamma squeeze, don't worry. I'm going to break it down in plain English without turning this into a boring finance textbook. Think of a market maker, the big guys who sell you option contracts. When they sell you a call option, they are essentially betting that the price won't hit a certain level. They collect your premium and hope the contract dies quietly. But here's the catch. They don't hedge based on vibes or feelings. They hedge based on a number called delta. When silver was suppressed early Thursday, the delta was low, meaning the dealers didn't feel the need to own many shares to cover their risk. But when price snapped back and closed above those key strike prices, the math changed instantly. Suddenly, their risk started rising faster than their comfort level. This is short gamma. As the price goes up, they are forced to buy the underlying stocks to stay neutral. Their buying pushes the price higher. The higher price forces more buying. It's a feedback loop, a self-reinforcing engine of chaos. The option sellers thought they were selling fireworks in a rainstorm, but the sun came out, the matches were lit, and now they're holding a burning fuse. Ask yourself, if the miners can explode 8.3% on a day when silver barely budged 2%, what on earth happens when silver actually starts a real vertical move? That is the cliffhanger that the mainstream analysts are too terrified to mention. They'll try to call this a random bounce or sector rotation. They use those fancy phrases because they missed the move. But you need to understand that mechanics don't care about opinions. We are witnessing the opening act of a multi-week forced repricing. The shorts are trapped in a room with no exits, and the floor is on fire. Intellectual, gritty, and confrontational. Focus. The gap between mining costs and silver prices, debunking critics, and the upcoming January 28th, 30th catalysts. Now let S talk about the fuel that S about to turn this spark into a full-blown inferno. Operating leverage. This is the secret sauce that most retail traders completely overlook. It's basic business math, but in the silver sector, it's currently on steroids. Think about it. A mining company has fixed costs: labor, diesel, equipment, and electricity. If it costs them $30 to pull an ounce of silver out of the ground and silver is selling for $35, they're making a modest $5 profit. But when silver surges into the 90s, as we're seeing in this narrative, their costs don't triple. Diesel didn't triple, labor didn't triple. Their costs might have ticked up, but their profit margin just went from $5 to over $60 an ounce. That's not an increase, that's an explosion. The market can ignore reality for a few months, but it cannot ignore a cash flow statement forever. We are heading straight into the heart of earnings season. A major US primary producer is set to report around January 28th, followed by a high beta favorite on the 30th. When those numbers hit the wire and analysts see the sheer amount of cash these ignored companies are printing, the narrative is going to shift instantly. Analysts will be forced to upgrade targets, and institutional funds will be forced to rebalance. Now I know the skeptics are out there. I hear them in the comments every day. Skeptic argument number 1. Inflation is eating the margins. My response: give me a break. Unless you think a gallon of diesel now costs $50, the math doesn't support you. Margins have expanded at a rate we haven't seen in decades. Skeptic argument number 2. Governments will just tax the profits away. For my response: resource nationalism is a real risk, sure. But policy moves at the speed of a turtle, while markets move at the speed of light. Many of these miners are diversified across multiple jurisdictions. You can't just press a tax button and stop a global repricing event overnight. Skeptic argument number 3. The big banks will smash the price back down. My response: I get the cynicism. I really do. But even a rigged game has to deal with physics. Physical supply is tight. Exchange inventories are trending towards zero, and industrial demand is relentless. Paper games work until the physical reality snaps the string. And folks, that string just snapped on Thursday. We are looking at a catch-up rally setup. In every previous bull run, the metal leads, the miners lag, and then, out of nowhere, the miners sprint. We are at the beginning of the sprint. If you're waiting for a safe entry, you were waiting for the moment when the profit has already been made by the people who understood the mechanics 2 weeks ago. Strategic and inspiring. Focus. Checkpoints. Tuesday open 16th level. Final warning against emotions and call to action. So, where do we go from here? I'm not here to give you financial advice, but I am here to give you a framework, a playbook for how to navigate this savage volatility without losing your mind or your capital. My first checkpoint is Tuesday's open. Remember, Monday is a market holiday, and that creates a pressure cooker effect. If the Silver Miners ETF, SIL, gaps up on Tuesday and holds that gap through the first hour of trading, that is a massive signal of continuation. It means the dealers couldn't satisfy the hedging demand over the long weekend, and they still chasing. My second checkpoint is the $16 zone in SIL. This is the trampoline level. If we see a minor pullback to this area and buyers step in immediately to swallow the dip, then the squeeze thesis is as healthy as ever. However, if we break below $14.50 on a closing basis, that's my hard line. That would tell me the structural ignition has fizzled out for now. But let's look at the bigger picture. Squeezes are designed to break you emotionally. You're going to see gap-ups that make you feel like you've missed the boat. Then, you'll see intraday dumps designed to make you panic sell right before the next leg up. The mainstream media will stay silent until the price is so high that ignoring it becomes embarrassing, and that is exactly when the dumb money will pile in. You have a window of opportunity right now, before the noise becomes deafening. I want to hear from the winners in our community. If you've stayed disciplined, if you've built your stack, or if you've nailed a trade this week, share your story in the comments. Seeing real-world wins helps everyone stay grounded when the charts get wild. And if you're new here, tell me, what's your biggest fear in a bull run? Is it buying too late or getting shaken out by a fake dip? Let's talk about it below. The logic chain is simple. OPEX created a trap, the trap snapped, forced buying began, and earnings are about to pour gasoline on the entire setup. This isn't just a trade. It's a mechanical repricing of a sector that has been ignored for too long. Check the description for those bonus links. The premium WhatsApp channel, and the membership options if you want the deep dive research my team is working on. Stay centered, track the mechanics, and don't let a green candle make you arrogant or a red candle make you a coward. I'll see you in the next one.